In this video I will explain you how to value a stock. There are many different ways to value a stock, and the appropriate method depends on the specific circumstances and characteristics of the company being analyzed. Please subscribe for more informative videos I will upload weekly. So common methods in valuing stock include price to earnings ratio, PE ratio, discounted cash flow model, comparable company analysis, and dividend discount model. 1. Price to earnings ratio, PE ratio. It is a popular ratio that gives investors a better sense of the value of the company. This method involves dividing the stock's price by its earnings per share. A high PE ratio may indicate that the stock is overvalued, while a low PE ratio may indicate that it is undervalued. The PE ratio shows the expectations of the market and is the price you must pay per unit of current earnings. The PE ratio is a measure of the price investors are willing to pay for a company's earnings. It is calculated by dividing the current market price of the stock by the company's earnings per share, EPS. For example, if a company has a market price of $300 per share and an EPS of $20, its PE ratio would be 15. A higher PE ratio may indicate that the stock is overvalued, as investors are willing to pay more for the company's earnings. A lower PE ratio may indicate that the stock is undervalued. So, finding the true value of a share cannot just be calculated using current year earnings. The value depends on all expected future cash flows and earnings of a company. Price-earnings ratio is used as a good starting point. 2. Discounted cash flow, DCF, model. This method values a stock by forecasting its future cash flows and discounting them back to the present using a required rate of return. This technique is flexible in that it can be used for very early stage growth companies as well as established companies operating in more mature industries. The DCF model is a method of valuing a stock based on the present value of the company's future cash flows. To calculate the present value of a future cash flow, you would divide the expected cash flow by the discount rate, raised to the power of the number of periods until the cash flow is received. The value of the stock is equal to the sum of the present values of all expected cash flows, discounted at an appropriate discount rate. 3. Comparable company analysis. This method involves comparing the stock being analyzed to similar companies in the same industry, taking into account factors such as financial metrics, growth prospects, and risk profile. Comparable analysis involves comparing the financial metrics of a company to those of similar companies in the same industry. Comparable company analysis operates under the assumption that similar companies will have similar valuation multiples. This can give you a sense of whether the stock is over or undervalued compared to its peers. Some financial metrics that are commonly used in comparable analysis include price to earnings ratio, enterprise value to sales, price to book ratio, and price to sales ratio. 4. Dividend discount model. This method values a stock based on the present value of its future dividends. It attempts to calculate the fair value of a stock irrespective of the prevailing market conditions and takes into consideration the dividend payout factors and the market expected returns. The value of the stock is equal to the sum of the present values of all expected dividends, discounted at an appropriate discount rate. To calculate the present value of a dividend, you would divide the expected dividend by the discount rate, raised to the power of the number of periods until the dividend is received. So if the value obtained from this model is higher than the current trading price of shares, then the stock is undervalued and qualifies for a buy, and vice versa. So summarizing the video, it's important to note that no single method is perfect, and a thorough analysis should take into account multiple approaches and consider the specific characteristics and prospects of the company being valued. Further important to note that these methods can be quite complex, and it is always a good idea to do your own research and analysis before making any investment decisions. If you enjoyed this video, please hit the like button and subscribe for more informative videos I will upload weekly.